Mm.
So, good evening, sir, and my dear friends. Today, we, the International Zone, are excited to present on the topic Rupee Depreciation. We are a team of 18 members and 4 group leaders from 9 different countries besides India, like Australia, Dubai, Poland, Singapore, the UK, and the USA. So, it's truly been a global effort, sir, and we're thrilled to share our insights with all of you. So, with your blessing, sir, let's get started.
Yes, all the best.
Thank you. So, I'm Apeksha and I'm here to break down what rupee depreciation actually means. Simply put, when the Indian rupee loses value compared to major foreign currencies like the US dollar, it's called rupee depreciation. For example, if the rupee weakens compared to the dollar, you'll need more rupees to buy just $1. Oh, and a fun fact, even though currently the dollar is roughly 86 rupees, back in 1947, 1 US dollar was equal to 1 Indian rupee. Imagine if that was still the case today, everything would be so much cheaper. And on that note, I'll hand it over to my friend Deepti.
Hello, I will take you through causes of rupee depreciation. Trade deficit arises when imports are more than exports, as seen in India. A higher import bill compared to export earnings results in higher demand for foreign currency, leading to this. Monetary policy gaps between US Fed and RBI have strengthened the dollar, driven by Fed optimism and low rates. To prepare for potential economic turbulence, RBI keeps on purchasing US dollars to safeguard India's financial stability, which also contributes to a weaker rupee. The Russia Ukraine conflict, rising crude oil prices, and other such global uncertainties lead to capital outflows from emerging markets like India, making the rupee weaker. Additionally, monetary policies by RBI keep changing to combat inflation, leading to rupee depreciation. Foreign investment outflows, Indian companies investing abroad, and transfer of money overseas by individuals also contributes to rupee depreciation. Over to Sakina for more.
The Indian rupee has experienced significant depreciation over the years. Here's a brief overview of its historical exchange rates against the US dollar with the annual percentage change at 10 years interval. What happened in 1991? In July 1991, under the governance of P.V. Narasimha Rao and Finance Minister Dr. Manmohan Singh, India devalued its currency. The exchange rate went from 17.90 to 23.07 per US dollar, a drop of 29%. As we know, depreciation is a gradual decline in the value of a currency due to its market forces, whereas devaluation is a deliberate reduction in currency's value by the governing authorities. In 1991, the Indian rupee was devalued by the government due to a severe balance of payment crisis. The crisis and the subsequent reforms marked a pivotal moment in India's economic history. Over to Ranjana, who will speak about rupee depreciation in recent times.
If you observe the table, the Indian rupee has depreciated by approximately 5.3% against the US dollar in the last 1 year. Factors that have contributed to this depreciation are the news of Trump to the US presidency in 25 brought back aggressive trade policies. For instance, Trump's 25% tariffs on goods from Canada and Mexico raised fears of a domino effect where other major economies, including India, face similar trade barriers. Year to date, global investors have withdrawn over 15 billion from Indian markets due to trade disruptions and economic slowdown, boosting dollar demand and weakening the rupee. The US Fed's limited rate cuts and prolonged high rates attracted investments back to the US, strengthening the dollar and depreciating the rupee. Over to Alka for more.
Export benefit. A weaker rupee makes Indian goods cheaper globally, boosting export volumes. Exporters earn more rupees per dollar, improving margins. Imports become costlier. Foreign goods, raw materials, and fuel become expensive, raising production costs. Costlier imports raise prices, making luxury goods more expensive and reducing demand. Over to Purnima for impact on inflation.
Rupee depreciation can have a major effect on inflation and cost of living. RBI estimates a 5% depreciation increases inflation by 35 basis points. As just discussed, imports become more expensive, leading to inflation, better known as imported inflation. For example, if a country imports a lot of oil, fuel prices rise, increasing transportation and energy costs, making everything from commuting to heating more expensive. Especially true for India as it imports 87% of its oil. It also drives up production costs, which businesses pass on to consumers. For example, higher prices for goods reliant on imports like energy, machinery, technology, or raw materials. This is known as cost push inflation. If businesses and consumers expect depreciation of the currency to persist, they may start adjusting their behavior, further pushing inflation. For example, businesses may raise prices preemptively and workers may demand higher wages. Over to Sunita on industrial sector.
The winners are clearly the export-oriented sectors. Key gainers include IT services, pharmaceuticals, automobiles, metals and jewelry, agriculture, tourism, including medical tourism and hospitality, as a weaker rupee makes Indian products and services more competitive globally. Local manufacturing gains benefiting industries like textile, electronics, and auto components. The losers remain the import-dependent sectors: airlines, electronic and consumer goods, telecom, construction, foreign auto manufacturers, and medical equipment importers suffer as import costs rise, making their products less competitive. Energy intensive industries are hit hardest as India's dependence on crude oil imports drives up fuel and logistic cost. Over to Ruchi for impact on foreign investments.
Rupee depreciation against major currencies, especially USD, affects foreign investments, influencing FPI, FDI, and stock market volatility. FIIs may sell stocks to avoid further losses, leading to capital outflows. Large FPI withdrawals also lead to sharp fluctuations in share prices. Foreign investors may delay investments due to uncertainty over rupee depreciation. A weaker rupee increases the cost of doing business in India for foreign companies. On the other hand, a lower rupee makes factories, land, and labor cheaper, attracting foreign manufacturers. Companies exporting from India may find it more attractive as production costs drop. Investors may short sell the rupee, betting on further depreciation, worsening the situation. Foreign investors increase currency hedging, reducing investment attractiveness. A falling rupee signals economic weakness, deterring foreign investments. Investors may exit the Indian market in large numbers, worsening stock market volatility. Over to Aparna for impact on the common man.
A depreciating rupee affects the common man by increasing expenses and financial strain. When inflation rises, fuel prices go up, making transportation and essential goods like food and electronics costlier. Imports become expensive, further burdening households. Savings take a hit as loan interest rates rise, making EMIs costlier, while stock market fluctuations impact investments. Travel and education abroad become more expensive as currency exchange rates worsen. Economic growth slows as the central bank avoids cutting interest rates, making borrowing costlier. On a positive note, NRIs benefit as their remittances fetch more Indian currency. Overall, a weaker rupee leads to higher costs, expensive loans, and a financial uncertainty for the common man. Over to Rima, who will speak about banking and borrowing costs.
Rising offshore borrowing cost makes it more expensive for companies and government to raise funds, increasing debt servicing costs and impacting profitability. Businesses with foreign currency debt face higher repayments as a weaker rupee requires more rupees to cover the same debt, effectively increasing their total debt burden. Leads to demand pull inflation in certain sectors as available supply of goods and services might reduce. If a business spends more on debt repayment rather than investing or expanding, it can slow down overall economic growth. Some companies opt for domestic sources of funding as hedging costs make offshore borrowing relatively unattractive. Over to Supriya for more.
As already pointed out, a weaker rupee makes imports more expensive, especially crude oil, fertilizers, and defense equipment, which India heavily relies on. Since fuel subsidies and other essential imports are government funded, a depreciating rupee increases fiscal burden. India has external denominated debt in US dollars. A weaker rupee means the government has to pay more rupees to repay the same dollar denominated debt and interest on bonds, worsening the fiscal deficit. A depreciating rupee leads to imported inflation, increasing food, fuel, and raw material costs. To control prices, the government may expand subsidies, further straining finances. On the positive side, a depreciating rupee increases export competitiveness, which can boost tax revenues from exporters. Over to Vandana for more.
We are now diving into the world of currency stabilization. Think of RBI as a lifeguard on duty, ensuring our rupee doesn't decide to take an unpleasant dive. To stabilize and strengthen the INR, the Government of India and the RBI implement several monetary policy measures. The RBI actively intervenes in the forex market by selling its foreign exchange reserves to boost INR demand and stabilize the rupee. Example, it sold 70 billion US dollars in December 24 to defend the rupee. A USD INR buy-sell currency swap auction is also used to manage liquidity in the banking system, ensuring cash flow. Here, the RBI purchases US dollars from authorized dealers, typically banks, in exchange for rupee, with an agreement to sell the same amount of USD back to these banks at a predetermined future date. This helps in mitigating the USD INR exchange rate volatility, keeping the interest rate stable. Example, on Feb 28-25, the RBI conducted a USD INR buy-sell swap auction worth USD 10 billion for a 3-year tenure, aiming to inject over 870 billion INR into the banking system. Another policy is an open market operation, which is a purchase auction of government securities by RBI. By purchasing government securities, the RBI provides the banks with additional funds, enhancing the capacity to lend and support the economic activity. Example, in Jan 25, RBI conducted purchase auctions of 60,000 crore in 3 tranches of 20,000 crore each. Over to Archana for more.
To tackle the rupee's decline, the RBI did more than just step into the forex market. In December 24, they cut the CRR by 50 basis points, reducing it to 4%. This move helped ease liquidity issues, keep inflation in check, and indirectly gave the rupee a boost. Then in Jan 25, they allowed NRIs to open special non-resident rupee accounts for transactions with Indian residents. The RBI also promoted international trade by encouraging rupee-based trade agreements and promoting the Indian rupee in global transactions. Over to Malvika for more.
Boosting exports by giving stronger incentives to key sectors like IT, pharmaceuticals, and textiles can be effective. Encouraging domestic production through initiatives like Make in India can reduce import dependence, and investing in renewable energy and pushing EV manufacturing can reduce our energy dependence on crude oil and fuel imports. Attracting more FDI by improving investor confidence and the ease of doing business will eventually lead to a greater demand for the rupee. Additionally, promoting FPI with better tax incentives and stable policies will lead to more purchase of Indian stocks by foreign investors. Lastly, higher interest rates on NRI deposits can encourage remittances, which will lead to more money flowing into the country. Over to Archana Vora.
Thank you. The government also adopts some fiscal policy and economic reforms to control depreciation. This includes reducing fiscal deficit by managing government spending and increasing revenue through effective taxation, improving trade balance by encouraging local manufacturing to reduce import dependency. It resorts to strengthening global trade agreements with export-friendly policies and encouraging rupee-based trade with partner countries to reduce dependence on the US dollar. Over to Archana Kalaru to conclude the presentation. Thank you.
This diagram of the vicious cycle of rupee depreciation explains how a drop in the value of the Indian rupee sets off a chain of events. It makes imports more expensive, which pushes up inflation. To control inflation, interest rates go up, but that reduces investment and hurts export growth. With fewer exports, there's less dollar supply, which weakens the rupee even more, keeping the cycle going. Breaking this loop is a big challenge for policymakers. In spite of these challenges, our finance minister attributed the rupee's volatility to a strong US dollar, noting its stability against other currencies due to India's strong economic fundamentals. Aided by a weakening dollar, the rupee had its best week in over 2 years. Analysts foresee long-term stability, citing GDP growth, foreign investments, and fiscal strength, while the government and RBI remain optimistic. Thank you, sir, and everyone for giving our team this opportunity to present to you.
No, I congratulate all of you. It is ultimate. Ultimate. I have not seen this level of presentation recently. Super, super.